Hey everyone, I'm back with video on another chapter which is capital gain. In this part I will be covering only 11 illustrations out of 25 illustrations, and the remaining I will be covering in my part 2 video of capital gain. Exercise I will be covering in my third part. Okay, the PDF file given in the description below contains only the exercise and illustrations of the ICI November 20 examination, as I have removed all the provision part from that PDF file. Okay, so keep watching my channel, like, share with your friends and subscribe for more updated videos, and press on the bell icon. So let's start with illustration number 1. X converts his capital asset acquired on June 10, 2003 for 60,000 into stock in trade on 10th March 2019. The fair market value on the date of the above conversion was 5,50,000. He subsequently sells the stock in trade so converted for rupees 6 lakhs on June 10, 2019. Examining the tax implications, cost inflation index for the financial year 2003 and 4 is given 109, financial year 18-19 is 280, financial year 19-20 is 289. Okay, as you all know that whenever capital asset is converted into stock in trade, then capital gain will be taxable in the year in which stock in trade is sold, and the fair market value on the date of conversion will be taken for the purpose of capital gain, and the fair market value which has been taken for the purpose of capital gain, that will be the cost for the when we sell the stock in trade for computing the capital business income. Okay, so let's see the answer. Since the capital asset is converted into stock in trade during the previous year relevant to the assessment year 1920, it will be a transfer under section 247 during the previous 18-19. However, the profit or gain arising from the above conversion will be chargeable to tax during the assessment year 2021, since the stock in trade has been sold only on June 10, 2019. For this purpose, the fair market value on the date of such conversion, that is 10 March 2019, will be the full value of consideration. As I said, full value of consideration will be on the date fair market value on the date of conversion. Okay, the capital gain will be computed after deducting the index cost of acquisition from the full value of consideration. The cost inflation index for the year 2003-4, that is the year of acquisition, is 109, and the index for the year of the transfer, that is 18-19, is 280. Okay, the index cost of acquisition is 60,000 into 280 divided by 109, that is 1,54,128. Hence 3,95,872 rupees has come after that from 5,50,000, that is a fair market value on the date of conversion, minus 1,54,128. it has come to 3,95,872. will be treated as long-term capital gain chargeable to tax during the assessment year 2021. Okay, that is it with the capital gain. Now let's compute the business income during the same assessment year. Rupees 50,000, that is 6 lakh minus fair market value on the date of conversion, will be chargeable to tax as profit, business profit. Okay, hope you have understood the illustration 1. Next is illustration number 2. Illustration number 2. M held 2000 shares in company ABC Limited. This company amalgamated with another company during the previous year ending 31st March 2020. Under the scheme of amalgamation, M was allotted 1000 shares in the new company. The market value of the shares allotted is higher by rupees 50,000 than the value of holding in ABC Limited. The assessing officer proposed to treat the transaction as an exchange and to tax rupees 50,000 as capital gain. Is it justified? As you all know, whenever any amalgamating company is amalgamated with another company, and amalgamated company is an Indian company, then capital gain is not taxable whenever any shareholders receives in consideration for the old shares or new shares of the amalgamated company, then it is exempt transfer. Okay, so in the above example, assuming that amalgamated company is an Indian company, the transaction is squarely converted by covered by the exemption explained above, and the proposal of the assessing officer to treat the transaction as an exchange is not justified. Okay, so it won't be taxable and it is an exempt transfer, as I said. So let's move on with illustration number 3. Illustration number 3. Okay, in which of the following situation capital gain tax liability does not arise? We have to calculate in which of the situation capital gain tax liability does not arise. Mr. A purchased gold in 1970 for rupees 25,000. Okay, in the previous year 1920 he gifted it to his son at the time of marriage. Fair market value of the gold on the date the gift was made was rupees 1 lakh. As you all know, in the capital gain, whenever a gift is made, then gift is an exempt transfer and no capital gain will be chargeable to tax. So let's see the solution. We know that capital gain arises only when we transfer capital asset. The liability of capital gain tax is in the situation given above is discussed as below as follows. As per the provision of section 47(3), transfer of capital asset under a gift is not regarded as transfer for the purpose of capital gain. Therefore, capital gain tax liability does not arise in the given situation. Okay. Now see question number second part. A house property is purchased by HUF, Hindu Undivided Family, in 1945 for 20,000. It is given to one of the family members in the previous year 1920 at the time of partition of the family. Okay. Fair market value on the date of partition was rupees 12 lakhs. So it is also an exempt transfer. Okay, because it is given, no consideration has been charged for this, so it will be exempt. As per section 47(1), transfer of capital asset being in kind on the total or partial partition of HUF is not regarded as transfer for the purpose of capital gain. Therefore, capital gain tax liability does not arise in this situation. Okay. Next is third part. Mr. B purchased 50 convertible debentures for rupees 40,000 in 1995, which are converted into 500 shares worth rupees 85,000 in November 2009 by the company. It is also an exempt transfer when debentures converted into shares of a company, shares of the same company, then it is an exempt transfer. Let's see the solution. As per the provision of section 47(10), transfer by way of conversion of bonds or debentures, debenture stock or deposit certificate in any form of company into shares or debentures of that company is not regarded as transfer for the purpose of capital gain, as I said. Therefore, capital gain tax liability does not arise in the given situation. Okay. Next, move to the illustration number 4. Mr. Abhishek, a senior citizen, mortgaged his residential house with a bank under a notified reverse mortgage scheme. He was getting loan from the bank in a monthly installment. Mr. Abhishek did not repay the loan on maturity and hence gave possession of the house property to the bank to discharge his loan. How will the treatment of long-term capital gain be on such reverse mortgage scheme? As we all know, reverse mortgage scheme is a scheme came up for the senior citizen, as they give the house property so that they can run their they can have on the daily basis they can have some income. So they give their house property to the bank or on reverse mortgage, and the bank on the monthly basis or on the lump sum consideration give the payment to the senior citizen, and on maturity if they are unable to pay the amount, then it is taxable. Then when the house property is taken by the bank, then at that time it is taxable. But at the time when reverse mortgage is given and bank is giving some loan to the senior citizen, then it is not taxable. Only at the time of maturity, if the senior citizen is unable to pay, then it will be taxable. Let's see the solution. Section 47(16) provides that any transfer capital assets in a transaction of reverse mortgage under a scheme made and notified by the central government shall not be considered a transfer for the purpose of capital gain. Accordingly, the mortgaging of residential house with a bank by Mr. Abhishek will not be regarded as a transfer. Therefore, no capital gain will be charged on such transaction. Further, Section 1043 provides that the amount received by the senior citizen as a loan, either in lump sum or in installment, in a transaction of reverse mortgage would be exempt from income tax. Therefore, the monthly installment amount received by Mr. Abhishek would not be taxable. However, the capital gain tax liability would be attracted at the stage of alienation of the mortgage property by the bank for the purpose of recovering the loan. As I said, at the time of if it is unable to pay, then if the bank takes away the property, then capital gain tax will attract. Okay, now start with illustration number 5. Nirja was carrying on textile business under proprietorship concern Nirja Textiles. On 21st July 2019, the business of Nirja was succeeded by New Look Textiles Private Limited. Okay, proprietorship concern has been taken over by a company, and all the assets and liabilities of Nirja Textiles on that date became the assets and liabilities of New Look Textile Private Limited, and Nirja was given 52% shares in the share capital of the company. No other consideration was given to Nirja on account of this succession. The assets and liabilities of Nirja Textiles transferred to the company includes an urban land which was acquired by Nirja on 19 July 2017 for 9,80,000. The company sold the same on 30th March 2020 for 15 lakhs. Okay. Examine the tax implication of the above mentioned transaction and compute the income chargeable to tax in such case. Cost inflation index is given for the financial year 13-14 and financial year 19-20. Okay. As we can see in the sums, when the proprietorship concern has been converted into a company, then it is an capital gain. No capital gain will be chargeable to tax, as all the conditions of respective section has been satisfied. So it will be an exempt transfer, and so whenever the urban land which is covered in the definition of capital asset, so urban land has been transferred by Nirja Textiles to a company, that is New Look Company, New Look Textiles Private Limited. It will be an exempt transfer, and the period of holding of the previous owner, that is the proprietorship concern, will also be counted, and the cost will be taken of the previous owner. So we will see in the sums that they have taken a different view regarding the cost of acquisition. Okay. Regarding the indexation, I guess for the indexation they have taken a different view, but in the note they have given whatever I have said, that indexation we can take out the previous owner as well, the date on which previous owner has acquired the asset, that is Nirja Textiles. So we will see the answer and I'll show you. Let's see the solution. Taxability in case of succession of Nirja Textiles by New Look Textile Private Limited. As per provision of section 47(14), in case of proprietorship concern is succeeded by a company in the business carried on by it, and as a result of which any capital asset is transferred to the company, then the same shall not be treated as transfer and will not be chargeable to capital gain tax in case the following conditions are satisfied. All assets and liabilities of sole proprietorship concern become the assets and liabilities of the company. As we have seen, it has become the shareholders of the sole proprietorship concern in the company is not less than the shareholding of the sole proprietorship concern in the company. Sole proprietorship in the company is not less than 50% of the total voting power of the company and continues to remain as such for a period of 5 years from the date of succession. We are assuming that he will continue for 5 years. It's not mentioned in the question. The sole proprietorship does not receive any consideration or benefit in any form from the company other than by way of allotment of shares in the company. As you have seen, he has received only shares, 52% shares in the company. No other consideration is received by him. In the present case, All the conditions mentioned above are satisfied. Therefore, the transfer of capital asset by Nirja Textile to New Look Textile Private Limited shall not attract capital gain tax provided Nirja continues to hold 50% or more of the voting power of New Look Textile Private Limited for a minimum period of 5 years. Okay, we are assuming that. Okay, so next continuation of this answer. Taxability in case of transfer of land by New Look Textile Private Limited. Okay, as per the provision of section 49(1) and explanation 1 to section 242A, in case a capital asset is transferred in the circumstances mentioned in section 47(14), the cost of the asset in the hands of the company shall be cost of the asset in the hands of the sole proprietor. Consequently, for determining the period of holding of the asset, the period for which the asset is held by the sole proprietor shall also be considered. Therefore, in the present case, the urban land shall be a long-term capital asset since it is held for more than 24 months. Because two things, for more than 24 months, that is, whenever any unlisted shares and land is held for more than 24 months, then it will be treated as long-term. So it is held for more than 24 months, so it will be treated as long-term. Let me read out once again. Therefore, in the present case, the urban land shall be a long-term capital asset since it is held for more than 24 months by the New Look Textile Private Limited and Nirja Textiles taken together. Okay. Cost of acquisition of land in the hands of the company shall be 9,80,000. That is the purchase cost of the land in the hands of the Nirja. Okay. So let's see, when the capital asset is sold by New Look, what capital gain will arise. Computation of capital gain chargeable to tax in the hands of New Look Textile Private Limited. Net consideration is 15 lakh as it is given, less index cost of acquisition, that is 9,80,000, that is cost of the previous owner, that is Nirja Textiles, into 289 divided by 289. Okay, so they have taken indexation, but as per my opinion, you can also do the indexation of the year in which the previous owner, that is Nirja Textiles, acquired. As let's see, when the indexation that is 220, we can solve it on that way also. If you write index 289 by 220, then also your answer will be correct. Okay, they have taken a different view, but further they have given a note regarding that. So 5,20,000 according to them, but let's see the note, what they are saying. The transfer of the year of transfer and the year in which company first held the asset are the same in this case, which is the reason why numerator and denominator for the calculating the indexed cost of acquisition would remain same. Therefore, in effect, there is no benefit of indexation in this case. However, as per the view expressed by the Bombay High Court in CIT versus Manjula J. Shah, 16 Taxman 42, in case the cost of acquisition of the capital asset in the hands of the SEC, in case the cost of acquisition of the capital asset in the hands of the SEC is taken to be cost of such asset in the hands of the previous owner, the index benefit would be available from the year in which the capital asset is acquired by the previous owner. If this view is considered, the index cost of acquisition would have to be calculated by taking the cost inflation index for the year 13-14, as I said, 220 being the year in which capital asset was acquired by the previous owner, Nirja, as the denominator in which the capital gain chargeable to tax would undergo a change. The long-term capital gain in such a case would be 2,12,636, that is came after 15 lakh minus 12,87,364. How 12 lakh came? It's shown over there. 9,80,000 into 289 divided by 220. You can solve it by this way. Okay, I'll prefer that everyone should solve it this way rather than the way institute have solved in the above. Okay, it will be correct because it's note in the note also they have given over there. So we can take this view also. Okay, it's better to take this view. Okay, so next, coming up with the next illustration, that is illustration number 6. Okay. ABC Limited converts its capital asset acquired for an amount of rupees 50,000 in June 2003 into stock in trade in the month of November 2017. Okay. The fair market value of the asset on the date of conversion is 4,50,000. The stock in trade was sold for an amount of rupees 6,50,000 in the month of September 2019. Okay. What will be the tax treatment? As we have seen in the first illustration, similar to that, but in that sum it was a little bit different thing. Okay. In the same year, the asset, in the year in which conversion takes place, in that year only the stock in trade is sold, but in this sum stock in trade is converted into a different financial year and it's taxable, and the year in which stock in trade is sold is different. So let's see the solution. Indexation is given of the 3 years in the year of acquisition by ABC Limited. Okay. And the year in which it's converted into stock in trade, that indexation is given, and 1920, the year in which stock in trade is sold, that year indexation is given. Let's see the solution. The capital gain on the sale of capital asset converted into stock in trade is taxable in the given case. It arises in the year of conversion, that is previous year 1718, but will be taxable only in the year in which stock in trade is sold, that is previous year 1920. Profit and gain from the business will be taxable in the year of sale of stock in trade, that is 1920. Okay. The long-term capital gain and business income for the assessment year 2021 are calculated as under. They have calculated first business income. Sale proceeds of the stock in trade is 6,50,000. Cost of stock in trade is 4,50,000. That is the fair market value on the date of conversion. PGBP income is coming 2 lakhs. Long-term capital gain, that is full value of consideration, that is a fair market value on the date of conversion is 4,50,000. And index cost of acquisition is 50,000 into 272 divided by 109. That is 272, the year in which asset is converted, and cost of acquisition is the year in which asset was acquired is 10. That year indexation is 109. So 272 divided by 109. So it is coming to 1,24,771. And after from 4,50,000, if we deduct that amount, it's coming to 3,25,229. Note: for the purpose of indexation, the cost inflation index of the year in which asset is converted into stock in trade should be considered. Okay. Now let's start with illustration 7. Miss Usha purchased 1000 equity shares in X Limited, an unlisted company, at a cost of rupees 330 per share, brokerage 1%, in January 1996. She gets 100 bonus shares in August 2000. She again gets 1100 bonus shares by virtue of her holding on February 2006. Fair market value of the shares of X Limited on April 1, 2001 is rupees 80. On 1st January 2020, she transfers all her shares at rupees 200 per share, brokerage expenses 2%. Compute the capital gain taxable in the hands of Ms. Usha for the assessment year 2021. Cost inflation index for the financial year 2001 and 2 is 100, financial year 5-6 is 117, and financial year 19-20 is 289. Okay, so as we all know that for bonus shares, if anybody doesn't know regarding this, in the provision it is written that whenever any bonus shares which is received before 2001-2, that is financial year 1-2, then fair market value will be taken for the purpose of computation of cost of acquisition, calculation of cost of acquisition. But any bonus shares received on or after financial year 1-2, then its fair market value will not be taken and its cost of acquisition will be nil. So in this case, 100 bonus shares fair market value will be 80 per share. Okay, and for 1100 bonus shares cost of acquisition will be nil. Okay, So let's see the solution. For computation of capital gain for the assessment year 2021, let's first calculate the original shares. 1000 original shares, sale proceed is 1000 shares into rupees 200, that is 2 lakh, less brokerage paid 2% of 2 lakh, that is 4000. Net sale consideration is 1,96,000, less index cost of acquisition is rupees 80 into 1000 into 289 divided by 100. Okay. For the purpose, as the fair market value has been taken, okay, so brokerage 1% it has not been taken. Okay, if the fair market value would have not been taken, then we would have added that 1%, but in this case fair market value is higher, so fair market value has been taken, so 1% has not been added in the index cost of acquisition. Okay, so it's coming to long term capital loss 35,200. Now bonus shares 100, sale proceeds 100 into 200, sale proceeds is 100 bonus shares into rupees 200 per share, that is 20,000, less brokerage paid 2% of 20,000 is 400. Net sale consideration is 19,600, less index cost of acquisition is rupees 80 into 100, that, as I said, fair market value has been taken, into 289 divided by base year of index cost inflation index, that is 100, that is coming to 23,120. That is again long term capital loss, that is 3,520. Okay, as we all know, for unlisted shares, period of holding 24 months for the purpose of capital, long term or short term. Okay, so for 1100 bonus shares, sale proceed is 1100 into rupees 200 per share, that is coming to 2,20,000, less brokerage paid 2% of 2,20,000, that is coming to 4,400. Net sale consideration is 2,15,600. Okay, cost of acquisition has been taken nil, as I said, as bonus was received on or after financial year 2001-2, so it will be nil. No fair market value will be taken, and bonus shares is received in free of cost, so no cost will be there. So capital gain is coming, long term capital gain is 2,15,600, and after that it's coming to, after setting off everything, it's coming to how much? 1,76,880. Okay, long term capital loss, all are long term two are long term capital loss and one is long term capital gain, so it can be set off and it's related to the shares itself, so it has been set off. See the note, cost of acquisition of bonus shares acquired before 1/4/2001 is the fair market value as on 1/4/2001, being higher of the cost or fair market value as on 1st April 2001. Okay, let's see illustration number 8. On January 31st 2020, Mr. A has transferred self-generated goodwill of his profession for a sale consideration of rupees 70,000 and incurred rupees 5,000 for such transfer. You are required to compute the capital gain chargeable to tax in the hands of Mr. A for assessment year 2021. It's a simple question. Solution: the transfer of self-generated goodwill of profession is not chargeable to tax. It is based upon the Supreme Court ruling in CIT versus B.C. Srinivasa Setti. You can see that case law. You'll get it anywhere from where the provision part you are covering. Even if you are not getting it, you can just write me on comment box. I'll explain to you. Okay. Now let's start with illustration number 9. Mr. R hold 1000 shares in Star Miners Limited, an unlisted company acquired in the year 2001-2 at a cost of rupees 75,000. He has been offered right shares by the company in the month of August 2019 at rupees 160 per share in the ratio of 2 for every 5 held. Okay, that means he is receiving 400 right shares. He retained 50% of the right and renounced the balance right in favor of Mr. Q for rupees 30 per share in September 2019. All the shares are sold by Mr. R for rupees 300 per share in January 2020, and Mr. Q sells his shares in December 2019 at rupees 280 per share. What are the capital gain taxable in the hands of Mr. R and Q? Financial year given and indexation is given, cost inflation index of the both the year. So as we see, Mr. R has acquired the shares in 2001-2, and after that he is getting the right of 400 shares, but he has purchased only 200 shares, and remaining 200 shares he has renounced in favor of Mr. Q. Okay, and he is getting from Mr. Q rupees 30 per share. Okay, but for the right which he is getting from the company, he is not paying anything. So for the purpose of computation of capital gain, for the right, cost of acquisition will be nil. Okay, and as it is a unlisted company in this case, so for the purpose of period of holding, 24 months will be taken for computing long term and short term. So let's see the solution. Computation of capital gain in the hands of Mr. R for the assessment year 2021, that is 1000 original shares. Sale proceed is 1000 shares into rupees 300 per share, that is coming to 3 lakh. Index cost of acquisition is 75,000 into 289 divided by 100, that is coming to 2,16,750. That is a long term capital asset. Capital gain 83,250. Okay, and next 200 shares which he has taken, which he has purchased, Mr. R. So sale proceed is 200 shares into rupees 300, that is 60,000, less cost of acquisition is 160 into 200. No indexation is done because it's a short term. In short term we don't do indexation. That is coming to 32,000. That is coming short term capital gain 28,000. Sale of right entitlement which he has received from Mr. Q. Sale proceeds 200 into rupees 30, 6,000. Cost of acquisition will be nil. Short term capital gain, okay, that is 6,000. Capital gain, total capital gain is 1,70,250. Okay, let's see the note. Since the period of holding of these shares is less than 24 months, that is note for this 200 right shares, cost of acquisition, less than 224 months, they are short term capital asset, and hence cost of acquisition will not be indexed. Note number 2, that is for cost of acquisition in case of right entitlement. The cost of right renounced in favor of another person for a consideration is taken to be nil. The consideration so received is taxed as short term capital gain in full. The period of holding is taken from the date of the right offered to the date of renouncement. Okay, it will be always short term. Now computation of capital gain in the hands of Mr. Q for the assessment year 2021. Sale proceed is 200 shares into rupees 280, that is 56,000, less cost of acquisition is 200 shares into, that is it has paid to the company rupees 160 and to Mr. R, that is rupees 30, total into rupees total is coming to 190 rupees into 200 shares, that is coming to 38,000, and its short term capital gain, that is 18,000. Note, the cost of right is the amount paid to Mr. R as well as the amount paid to the company. Since the holding period of these shares is less than 24 months, they are short term capital assets. Okay, now let's start with illustration number 10. X and Sons HUF purchased a land for rupees 1,20,000 in the previous year 2-3. In the previous year 6-7, a partition take place when Mr. A co-partner, is allotted this plot valued at rupees 1,50,000. In the previous year 7-8, he has incurred expense of rupees 2,35,000 towards fencing of the plot. We can say cost of improvement. We can say Mr. A sells this plot of land for rupees 15 lakh in the previous year 1920 after incurring expense to the extent of rupees 20,000. You are required to compute the capital gain for the assessment year 2021. Financial year and cost inflation index is given of 2-3, 6-7, 7-8 and 1920. Okay, let's see. So let's see the solution. Computation of capital gain tax for the assessment year 2021. Sale consideration is given 15 lakhs. Expense incurred for transfer is 20,000. Index cost of acquisition is 1,20,000 into 289 divided by 122. Rather, they should have taken 105 instead of 122 because cost of acquisition of the previous owner is taken. So the index cost of indexation of that year should be taken. Cost inflation index of that year should be taken, as it was an exempt transfer, so it should have been taken 289 divided by 105 instead of 122. We'll see in the note they have answered that way also. So it is coming to 284 262. Okay, as per their solution. Index cost of improvement is 2,35,000 into 289 divided by 129 in the year in which they have incurred the expenses. Okay, so that is coming to 5,26,473. They have taken correctly. So that is coming to 8,10,735, and total long term capital gain is coming to 6,69,265. See the note. As per the view expressed by the Bombay High Court in CIT versus Manjula J. Shah 16 Taxman 42, in case the cost of acquisition of the capital asset in the hands of the SEC is taken to be cost of such asset in the hands of the previous owner, the index benefit would be available from the year in which the capital asset is acquired by the previous owner. If this view is considered, the index cost of acquisition would have to be calculated by considering the cost inflation index for the financial year 23. Okay, as I said, they have not shown the calculation, but you can calculate it yourself. But I'll tell you to do the cost inflation index of the 2002-3 rather than the year of 6-7. Okay, that is also correct. Now last illustration of this video. Mr. C purchased a house property for rupees 1,06,000 on May 15, 1975. The following expenses are incurred by him for making alteration to the house property. Cost of construction of the first floor in 1982-83, that is 3,10,000. Cost of construction of the second floor in 2002-3 is 7,35,000. Reconstruction of the property in 2012-13 is 5,50,000. Okay, as we all know, any cost of improvement done before 2001-2 will not be taken. Okay, fair market value of the property on April 1, 2001 is 8,50,000. Okay, the house property is sold by Mr. C on August 10, 2019 for 68 lakhs. Expense incurred on transfer is 50,000. Compute the capital gain for the assessment year 2021. Cost inflation index is given for 2001-2, financial year 2-3, 12-13 and 19-20. Okay, computation of capital gain of Mr. C for the assessment year 2021. Gross sale consideration is 68 lakh as it is given. Expense on transfer is given 50,000. That is net sale consideration is 67,50,000. Cost inflation index we'll see in note, and cost index cost of acquisition is given in note. We'll see there. Index cost of improvement is given in note. We'll see, and after that we'll come back. Okay. Index cost of acquisition is 8,50,000 into 285 divided by 100. Okay. It was given fair market value, that is 8,50,000 into 289 divided by 100. Okay, as it was acquired before 2001-2. Okay, fair market value on 1st and April 1, 2001. Actual cost of acquisition is ignored as it is lower than the market value on 1st April 2001. Okay, 8,50,000 will be taken as it is higher. Now it has coming to index cost of acquisition coming to 24,56,500. It has been entered upside. Okay, now let's see index cost of improvement calculation. Cost construction of the first floor in 1982-83. As I said, any improvement done before 2001-2 it will be ignored. Expense incurred prior to 1st April 1, 2001 are not considered. It will be nil. Construction of second floor in 2002-3 is 7,35,000, and the year of transfer is 280 indexation 289 and divide by 105, that is indexation of the year of 23 105. Okay, and alteration construction in 2012-13 that is 5,50,000 into 289 divided by indexation of the year of is 200. Okay, see 200 given. So total coming to index cost of improvement is coming to 28,17,750. So it has been entered upside, and total is coming to index cost of execution and improvement coming to 52,74,250. So total long term capital gain is coming to 14,75,750. That's it. Now I've covered all the 11 illustrations. Further illustrations I'll be covering in my next video. Hope you all able to understood the sums, illustrations. If there is query, please write me on the comment box in case of any doubt. I'll try to resolve the query at the earliest. Stay tuned for my next video on capital gain. Like, share with your friends, and subscribe my channel for more video, and also click on the bell icon. Here's another announcement. If anyone want to solve ICI indirect tax, that is IDT questions for November 20 examination, they can subscribe the channel given in the description. Eat healthy, stay healthy. Bye bye.